Welcome, everybody, to the Cross Country Super Podcast, the first one for 2026. So, if it's not too late, I will wish everybody a happy new year. And as usual, I'm joined by Jemma Sanderson over in beautiful Western Australia in Perth. How
Hi,
are you,
Darin.
Jemma? As
I'm
usual,
good.
it's always great to see you, and I should wish you as well happy new year.
I know it's the end of Jan, so it feels weird, but yeah, it still is. Happy New
Yeah, well,
Year.
we haven't seen a lot of people yet, so I suppose it's
I
still pretty
know.
relevant. But I suppose once we click over into February, you probably shouldn't be doing it anymore.
No, exactly.
And this podcast is brought to you by SMSF Property Valuations. As an accountant or SMSF trustee, do you need a valuation that satisfies ATO rules, includes documented methodology, and ticks all audit boxes? SMSF Property Valuations delivers an easy online ordering process to finish the job quickly. And as I always say, valuations are only going to be ramping up in their importance. Not that they weren't important before, but certainly scrutiny and focus around valuations is about to
Be off
increase
the charts. Yeah,
exponentially
that's right.
with some of the new stuff coming in. And that's a pretty good lead into, and I know that you might be a little bit tired of us talking about it. We're certainly tired of talking about it because we've been talking about it for the last 2.5 years, it feels.
Yeah.
Um,
3 years. It's going to be 3 years
oh,
in
well,
February.
3 years. And you guessed it, no prizes for guessing. We're going to talk about Division 296 tax. And the only reason why we're doing this is because the government pulled a little bit of a sneaky one on us at the end of 2025. Now, this is actually pretty interesting because I had some pretty reliable sources tell me, "Oh, don't worry about it. Nothing's going to happen." Because cynically, we were all saying they're going to, drop the bill on Christmas Eve
Christmas Eve. Yeah.
and ruin everybody's Christmas. Now, I was given reliable information that, oh no, don't worry about it, Darren. I've been told that nothing's going to happen before the end of 2025. So you can enjoy your Christmas. We don't have to worry about this. Let's pick it up again in 2026. And that's when we'll see the draft legislation. Well, no, they didn't stick to that, did they? They
No, they did
released it
not.
on the 19th of December, just when we were all packing up to go to Christmas. I'd actually finished publishing. I had to do like my one last article for the year was because they dropped the legislation. So you can imagine how amused I was about about that timing. But
Yeah.
not just me, obviously, people having to pore over what was going on, what had been released, and of course, submissions were due before the 16th of January. So they didn't have a lot of time to actually go through what had been released, um, see maybe some of the flaws that are there, and then put together a submission and some recommendations, hopefully that the
Hmm.
government will take on board. So it kind of disrupted everybody's break a little bit,
Yeah, it's
mine
a bit
at
rough, I have to
least, I
say.
would say.
Hmm.
But look, there are one or two quirky things, so we just thought we'd reiterate what was released and kind of where we're at now, now that the consultation submission period is finished, and hopefully Canberra will be looking in earnest at what some of the feedback is, and I've got my fingers crossed that they they will heed some of the suggestions that they receive because as we go further into this podcast, you'll understand what I'm talking about.
Why? Yeah. And they, there's precedent for that because they obviously heeded all of the feedback and criticism of the previous rules and did a massive backflip in October by saying, okay, we've taken on board unrealized gains, not fair. We're going to target realized earnings. So it was like, wow, that was quite unexpected, especially because of the practical implications of that, and obviously with the release of this draft legislation that goes through what some of those bits and pieces look like. So should we just touch on, I guess,
Yeah,
what the
let's
what
just
it's looking like now?
yeah. So let's just reiterate
Yeah,
what amendments were made to the original bill and some of the things that have now been highlighted with the draft legislation that
yeah,
Maybe it needs a little bit of work.
Needs a little bit of tweaking. So originally, so February 2023, I can't believe that's nearly 3 years ago. We had, if you're over 3 million, then you're going to be whacked with this extra up to 15% tax. The extent to which you're over 3 million on the difference between your opening total super balance and closing total super balance with adjustments for withdrawals and contributions effectively. That will be your Division 296 earnings. Apply the proportion you're in excess of the 3 million times 15%. And so the biggest criticism, and it wouldn't be that 3 million wouldn't be indexed. So the biggest criticism of that is obviously its market values. So it's capturing unrealized gains, and particularly for farming, SMSFs that have got chunky assets like farming property and some speculative shares, things like that, where the cash flow isn't necessarily there, but the values are high, then where are they going to get the money from in order to pay that? So again, that's very high level, lots of other nitty gritty. Then lots of criticism post the election in October last year. The Treasurer announced that they would be looking at realised earnings, but because of that, the inclusion of another threshold. So we've got 3 million. If you're over 3 million, then you've got the 15% proportion of 15% that will apply. If you're over 10 million, you've got a proportion, the proportion you're over 10 million would have an additional 10% tax. So that was a bit of a nasty sting in the tail, but it would be indexed and it would only capture realised earnings. So again, high level, that's what that looks like. Now, the practical application of that is where that's flowed through into this new legislation. So interestingly, so the feedback right at the get-go was, okay, realised earnings means a realised capital gain. So if you bought an asset 20 years ago in your fund, and then there was a realised gain after 1 July 26, because that was a new start date for all of this, then you'd be paying the realised earnings, which was effectively going to look at taxable income, add back exempt current pension income, adjust for contributions. That would include the realised taxable gain from way back when. So the other part of that release was it would only be realised gains on an asset from 1 July 16 that would be caught. So then we've been talking about having a second CG, well, it's not really CGT, but a second cost base for assets. What is that going to look like? How are the big funds going to do it? Is it going to be at the asset level as well as within an asset? So what I mean by that is a lot of super funds have got investments in ETFs or managed funds or closely held trusts or widely held unlisted trusts that might have had been in place for 10 years, and the property that was in there was bought 10 years ago and has now gone up in value by 10 million bucks. So if that property is sold, that would be the distribution of a gain after 1 July 2026. That would be included in the taxable income, but are you getting to run a cost base, a new cost base on that? So lots of little bits and pieces. One of my biggest concerns with all of this as well is the practical implementation of it, because it's a 1 July 26 start date. So what is all of that going to look like? So anyway, that was October. And then, of course, as a very lovely Christmas present, thanks Treasury, on the 19th of December, we get these drafts. So by and large, it covered off on what we knew in October. The consideration was, so throughout this whole journey since Feb 23, it's always been looking at what is the closing total super balance. So from that perspective, in the first round of announcements, because it was based on opening balance, closing balance, what's the difference, add back withdrawals, take off contributions. If you took a big withdrawal out of the fund, that sort of got added back in terms of what the earnings figure was, but your closing total super balance included the withdrawal, so it was lower. So the extent to which you were over 3 million was lower. So that's sort of how that worked. So to combat that somewhat, because what a lot of people were, and this isn't, a bad thing to do. I don't want to pay much. I don't like paying Div 296 tax. No one likes paying new taxes. I'll just take a big withdrawal out of my fund and fall below the threshold at 30 June, and then I'm out. Well, no. that was a bit of a game changer in there, which was it's based on the higher of your opening balance and your closing balance. So if you start at 9 million and then you pull out 6 million to go to the 3 million, you might be thinking, oh, I'm not subject to this. Or if anything, it's an increment. It's the greater of the two. So that's a big consideration. And especially when you overlay that with things like divorce and you might be reassigning or splitting super accounts on death when you've got people that with reversionary pensions as well as you start a new pension and dealing like because there's no issue, there's no consideration, and I'm going all over the place here, Darin. Sorry, from the perspective of if you die, your estate is still subject to this tax. So there's no longer that whole if you die before the last day of the year, then the tax doesn't apply. That is still relevant, but only if you die before the 30th of June 2027. So there's all these other. So it's the greater of closing and opening. Right. Well, I'll take a breath there.
Yeah, yeah.
Um,
There's a little bit to unpack there. I think on your last point, the death point. Yes, we're very happy that the anomaly has gone. That if you die on any day, you're exempt apart from the 30th of June, then you're up for it. We're glad because that's I mean, no sensible person would think that is reasonable. But unfortunately, they've gone the other way where it's
yeah.
just like, well, all right, we'll just take death out of the equation now. So it doesn't matter whether or not you die or not in that year. If you're up for it, you're up for it. And that
And
means,
and and in future years too. So sometimes a super account can take a long time to deal with. If you've got a member who's a single member sole director, then the estate is in dispute, then that super fund could sit there for years earning income and Division 296 earnings. And then you've got years and years and years of you're going to have probably returns that aren't done. They all get done, and then boom, you've got 3 years worth of Division 296 liability that needs to be factored in to everything. And that, I mean, it's hard enough to pay out someone's benefits out of super when they die. Overlay this, and anyway, don't
well,
get me
as
started,
we've
Darin.
discussed in the past, Gemma, what is the definition of as soon as practicable?
Exactly. Yeah.
We see situations all the time, court cases all the time that we're told about, whereby, the proceedings, I don't know whether or not it's because the death benefits are contested or whatever, but whatever happens, the proceedings just drag on, not because uh, they necessarily want them to, the related parties necessarily want them to. It's just a matter of that whole process takes a long time to do it. So
Yep.
while I know that everybody says rule of thumb is 6 months,
Six to 12 months. Yep.
and that sounds like a reasonable period in the scheme of things, but when you're talking about, legal stuff, and the involvement of maybe a lot of or a few external parties, such as lawyers who wouldn't normally
Yep.
be involved in the running of the super fund,
Yep.
that can actually really drag out. So you're right, Gemma, it's not just in that year of death.
Mm.
It just means that it captures that that person's liability, if you want to call it, to the new tax ad infinitum until their situation is resolved. Nice little trick, that one. And look,
Mm.
I get it.
Unless they die before 30 June 27,
Yes,
and
yes,
then
of
then
course.
they're then it doesn't
Then they're
apply.
then they're in the clear.
Yeah,
Now,
but the
I
challenge
get it.
there is it's an individual tax. So then the estate is going to be subject to it, but the individual who had the account, they're dead. So, the nuances of that legal side of things, can who like the release authority that's going to the fund to pay the tax, all of those sorts of things. And then if you've got different beneficiaries, so say the super fund beneficiaries are the children from the first relationship, but the estate is going to the new spouse, then if you're running the estate and there's a $300,000 Division 296 liability, you'd be saying, oh, well, we'll release that from super, thanks. But then if you're the kids who might be getting the super, you'd be like, hang on a sec, no, that's that's an like so you can just I can the lawyers are going to be the winners in all of this. So that's one,
Uh,
one
uh,
of the considerations.
Well, and I get, look, obviously, everything that we've been objecting about from the get-go, especially with the taxation of unrealized capital gains, was the unfair nature of it. Now,
Yeah.
the whole reason why Jim Chalmers has been very pig-headed and stubborn on not moving on this until it got to the stage where I don't think it was viable for them not to actually make some amendments, was the fact that they've included the revenue in the forward estimates, and he didn't
Mm,
want to have a hole in that.
yeah.
It's all about their fiscal management. So I get it. If the mechanism where you thought you were going to get the windfall because you were taxing unrealized capital gains is gone now, plus indexation
Plus
has been,
indexation. Yeah.
has been introduced, which probably further erodes the big
Erodes the revenue. Yeah.
gain that you're going to get, then I get it. You're going to have to come up with other methods to try
Yeah.
and compensate for the revenue that you're not going to get from the original method of calculation. And this is probably one of them. But again, and I have to say, for the whole thing, Gemma, I think this has been very, very not only poor policy, but very poorly put together policy as well. So
Execution has not been great.
yeah, so
Agree.
the
Yeah.
fact that you know, I mean, and these aren't small things around the edges. These are chasms that if they're not sorted, they're going to have, some pretty significant implications
Mm.
um, for people out there. And I mean, well, do you want to call it effectively another form of a death tax? Because it effectively
Mm,
could be if it
if you
draws
could
on.
do,
Yeah.
it's
So
just, yeah. So,
it's just a sneaky way of doing this stuff. Yes, I know that if they're so reliant on the forecast that they put into forward estimates, that they have to adhere to this. Yeah, but you know, do you learn your lessons that there are ways to do things and there are ways not to do things, and maybe you should sit down and think about it a little bit more. So yeah,
well, one
that
of the
death,
comments in the explanatory memorandum of why, why they were using the large, the higher of opening and closing was that uh, from the consideration of the taxable income is there. So that sort of thing shouldn't impact how it's taxed. It's like, but that's the whole point of your thing is that you're saying a proportion of it is taxed because you've got too much money. So that sort of flies in the face of that. And likewise with the super is, I guess there's a disincentive there, or there's an incentive there for people to deal with a death benefit sooner rather than later. So it's not subject to this tax. And then getting it out of super into someone's name or an alternative structure where it's taxed at the higher rate. Anyway, I like throughout all of this, I mean, no one likes paying a new tax, absolutely. I just don't like the extra admin and the practical implementation of it
yeah,
that I think
yeah,
is just going to be a bit of a pain in the backside.
yeah.
The other thing with that is, move on to the next thing is that you've got so
Well,
helpfully,
before we move on, can I
yeah.
just make a point about the TSB thing? So the TSB thing is quite a significant change because the way the total super balance is being incorporated now is different. As you
Mm,
say, it's the higher of the two. So it doesn't matter if by the end of the year you're under the threshold. If you're over the threshold at the start, bad luck, buddy, you're still up for it.
mm,
Which basically means that and I know this was all speculative because the prudent advice is, look, you can get your head around this, but don't do anything about it until it comes into law because it
yeah,
would be foolish to do it because in some ways you would be jumping at shadows a little bit, only to find out perhaps later that, oh, Jemma, I didn't actually need to do that. And
need to do that. Yeah,
I've ripped this money out of super and now I can't get it back in. Like I really regret it. So there was a lot of caution about, yeah, get your head around it, but don't necessarily do anything. But a lot of as you said, a lot of the strategies that were being, considered at the time were to pull money out to get under the
yeah.
thresholds, right? So that you would be okay in any given year. So at the end of the year, if you're under it, you'd be fine. That obviously has gone out the window. Apart from the only time, a little bit like death, the only time that it would be effective is before 1st
30
of
June
July.
27.
Yeah,
Yeah.
yeah, yeah, because that's the first assessment
Mm.
period. Now,
So I think that
if
from
we,
that perspective is like so that's I mean there's time then for people to take action if that's what it is that they want to do. They're constantly with that whole oh well I'll just pull money out of super consideration is well, if you pull out $4 million, $1 million, half a million, whatever the amount might be, what are you doing with the money then? So if you're gifting it to kids to pay down mortgages, that's a tick in the right box sort of thing because you're looking at succession and things. Now, obviously, that in itself is do you lend it to them? What do you do outside super from a family law and asset protection? Do you gift it to your kids for them to put into their own super? Do you try and look at all those sorts of things? But if you're investing that money, so you pull out $1 million and then you're investing that money in your discretionary trust or in your company, then if you're on the highest marginal tax rate, if it's going through your trust or you're doing it through a company that's paying 30% tax, that's generally still going to be a higher rate than keeping it in super and being subject to this tax. So it's really everyone's going to have different circumstances, and the profile of assets will impact that as well. Because if so, this is obviously on now realized gains, not just unrealized. But a lot of people they might like buy assets and not churn through them, but the longevity of them holding particular assets might only be 2 or 3 years. So at least I guess, the first 2 years of a 3 year cycle of an asset, they at least aren't paying tax on the increase in value of that. But then they're still going to get hit with it at the end. At least they've got the cash flow, so they're not completely immune if you've got an asset that you buy for bought 10 years ago and it's property's probably a prime one here, then you might be holding that for 20 years, so at least that's a good outcome, in terms of the increase in value isn't being subject to tax, but that increase in value might start ratcheting you over some of these thresholds, so there still is an impact. So it's running the numbers. What's the alternative? What's the longevity? Like a lot of the people that are subject that are in these thresholds, they're retirees. They've been retired for a couple of decades even. So that's where it's just giving rise to a wider conversation about other things.
yeah, it's a difficult one, but always with that strategy, it is scenario analysis, really,
Yeah,
isn't it?
that's right.
Yeah.
Exactly.
If I do this, what happens then? Where do I
Yep.
go? Now, I know that I said that strategy is kind of irrelevant now. It's not completely irrelevant. It's
No.
obviously relevant until the first period. It can be relevant after you've been caught if you make a conscious effort to right. Well, from now on, if I get my balance at 30th of June for this year down below it, I'm going to keep it below. Then you might
Yeah.
be okay, but you won't be able to do it if at any point in time during the year that balance, or at the start of the year, that balance was above the threshold. So this has just
Or
changed
you
the
try and
dynamic.
keep your balance pretty like neutral, like you're saying. So
Yeah,
yep, I get income, I get realize a capital gain. I'll just pull that out and I'll just keep my,
yeah,
balance,
yeah,
as much as you possibly can. But again, it's figuring out what it looks like. The other thing is if again, if like I want to take the money out because I want to give some money to the kids, but it's in 5 years' time. So if you start at 12 million and you're like, okay, I'm going to gift each of the kids $1 million. So you pull out three. And so you're down to nine at the end of the year, making up some numbers. So your calculation of the TSB for that year will be based on the 12, even though you're down to nine. So that's not ideal. But then it's just that sort of one, and then it goes down from that perspective. Where I don't like it is back to the death. So if you've got the consideration that Bob dies and he started at 12, and then at the end of the year it's at 14 or something like that. So the calculation for that year, and I'm assuming it's beyond 1 July 27, the calculation for that year will be based on the 14. And then if benefits, because if he dies towards the end of the year, now if his benefits, are still in place, obviously at the end of that year, the next year his account gets drawn down to zero because a pension starts for the spouse and the balance comes out as a lump sum, then it might be at zero at the end, but it started at 14. So whatever he's attributed with from a Division 296 perspective over the course of that year, that will still be whacked at a $14 million sort of threshold. And so that probably dovetails well into how the Division 296 is going to be calculated. And it's not, so it's realised earnings. You take off assessable contributions, you add back exempt current pension income. So we're talking taxable income here. Then you make an adjustment for the CGT, which I'll get to. But then it talks about that would be allocated to each member uh, based on actuarial percentages effectively. Now, what it actually says is that fair and reasonable basis, but then it goes on to say regulations will be introduced to cover off on that, but likely from an actuarial perspective. Now, a self-managed fund often will have to get an actuarial certificate every year, especially again people in this realm. They've got pension accounts. They're having to get actuarial certificates every year. So hopefully that process is reasonably straightforward and isn't too onerous and is basically just confirming perhaps the same sort of calculation, but at a member level rather than a particular account level. So again, you're incentivized to pull out the money sooner rather than later, because if Bob's $14 million can be dealt with by September of that next year, then the proportion of Division 296 earnings attributed to his account would be a lot lower. So anyway, that's what that's all looking like. But yeah, it's just I don't love it. And then everyone I'm sure who listens to this knows that I don't like reversionary pensions. So this is like another reason, especially if you've got the situation that Homer and Marge, they've both got 2.5 mil each in super, in pension, and one of them dies and it automatically reverts to the other. All of a sudden in that year, that person has $5 million in their court. So in that first year, whereas if it was not reversionary, you could finesse it a lot better. So anyway, I'm just,
Yeah, no, you make a good point. I think as it stands now, and look, I'm not under the impression that there won't be some fine tuning here as
yeah.
some of these gremlins come out. But could we see more of this situation where, if you're in failing health,
You rip it all out.
yeah.
Yeah, totally. Yep. Which is good
So,
from a death benefits tax perspective anyway.
but then, on another front, that will probably increase increase the scrutiny and the issue of when a member
Remember, yeah.
decides to withdraw, but then dies and it hasn't been paid out, and that whole situation's
The other thing with that is, blended families, the consideration, like the example I gave earlier, if your estate is going to the spouse and your super is designated to go to your kids, if you undertake that whole pull the money out before you die strategy, then what's going to the kids? If you don't look at it holistically from a proper estate perspective, then that's going to be a
yeah,
disaster for a lot of
that's
people
a
as well.
that's a difficult scenario, isn't it?
Mm,
I think that point was actually raised at the Tax Institute's superannuation conference
yeah.
about are you potentially going to end up with warring factions
Mm,
over the death
totally.
benefits because some children are looked after or some parties are looked after via the estate, whereas the member has said, "Oh no, 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 but I want my super to go here." Now, if a decision is made whereby either of those pools of benefits are diminished, of
Someone's
course
going to crack
people are
it.
going to be up in arms.
Yeah, that's right.
You're certainly not going to sit back and we know how litigious and we know how um, you know aggrieved people can be over death
Yep.
benefits. I mean, it happens. It's only increasing in its level of popularity in
Litigation
court. Yeah,
and
that litigation is
balances.
going to
Yeah.
go through. So, is this going to create a whole new dynamic of death benefit and estate challenges?
Yep, I think so.
Who knows? I mean, again, we're only at the infancy level, but you can already, if we project 5 steps ahead, which the government never seems to be able to do,
Well, they're
uh,
only looking at their forward estimates or the end of their next term, trying to,
that's right. And that's probably, look, I don't want to get
unfortunate.
soapbox here, but that's probably the root of the evils here,
Yeah,
right now, is looking
yeah,
so short term rather than long term, what is actually good policy here.
yeah.
And yeah, as I said
And the
before,
complexity. So, as an example, obviously they've now looking at indexing the threshold, so the 3 million and the 10
yes.
million. Now that's another bloody threshold that we're having to index. Is it CPI? Is it a WATI? Like, all of those things constantly are annoying to look at. Then we've got the transfer balance cap. So, like when talking about these rules coming in, transfer balance cap 2 million, new $3 million threshold and $10 million threshold. And if I reflect back on, you've got your concessional cap, which is currently 30 grand. The non-concessional cap is 4 times that. And then the other non-concessional thresholds are then, 3 times, 2 or 3 times that. So I know the Tax Institute in their submission to this put in place the consideration of, why don't we just make it a bit easier, instead of saying this is indexed at CPI, put in at $150,000 increments or $500,000 increments. Why don't we just benchmark it to the transfer balance cap? So if the transfer balance cap goes up, then this is 1.5 times for the lower threshold, and the upper threshold, so there's the um, large balance super threshold and the very large super balance threshold. I really take umbrage to that terminology, very large. Like, who's making that call that it's very large? Like, and large again, what's anyway, they could just call it something else. Anyway, I digress. But so right now in this current year, 2 million, 1.5 times that is 3 million, 5 times that is 10 million. That makes sense. But then, just this week, CPI figures came out. So transfer balance cap next year is going to be 2.1 million. The concessional caps are likely to be 32,500, and that flows out. So all of a sudden, these different benchmarks it's just going to do my head in and do everyone's head in. And you talk about complex, those thresholds just constantly.
Yeah, I actually saw that. I saw that submission from the Tax Institute. I thought it had great merit because, you know, we have numerous complaints about there being too many superannuation thresholds and
Yeah.
none of them being linked as far as how they're indexed or whether or not they're even
Mm.
indexed at all. We've got some that have
Yeah.
remained,
Still at 1.6
yeah,
million or
at
500
at
grand.
their
Yeah.
original level, and then we've got others that have moved. I thought it
Mm.
was a very sensible suggestion, seeing that it would, just for a small thing, it would add a little bit more simplicity to
Yeah.
what's going on. And that's what we want because there's so much more complexity
So
around
much more going on.
everything else, every other element of this tax that just concede a little bit of ground to make it slightly
Slightly better. Yeah.
simpler than what you're proposing. But on a cynical level, Gemma,
Well, they're not going to do that now because it's gone
well,
up to 2.1. So they're not going to say, oh, well, all of a sudden,
well,
the
I would,
this
yeah,
is, 1.5 times. So,
I
or
would say
5 times.
philosophically, you're right. I would say philosophically, I totally agree with that. But from a really, really cynical point of view, which I am a big cynic, um, the Treasurer's not going to agree to that when he can't get inflation under control.
Yeah.
So he's not going to
Never
want
not going to
these
agree to that.
thresholds to
Yeah.
keep going up
Yeah.
and sit there realizing that it's not netting any revenue because the
Yeah.
indexation is pushing it out.
Off the charts.
He's
Yeah,
not going to be able
exactly.
to, he's not going to do that. So I think, while I think it is actually a great suggestion, yeah, I think
It's
that's
not
going to,
going to happen. Well, let's talk about then, because it's such a simple new tax to get our heads around. Let's talk about one of the like more complex parts of it, which is this second cost base that we're going to have to be
yes.
considering for our
Yeah.
clients. So it's not a CGT reset, and I really am like, I stumble over that and say, oh, when we reset the cost base, we are not resetting any cost base at all whatsoever. We are running a second cost base, and it's a cost base for Division 296 purposes only. Tax purposes will remain the same. So you bought it back then, you sell it. This is what, from a tax perspective, that's what it looks like. However, from a Division 296 perspective, the value of, and it's an all or nothing. It's an election and it's an all or nothing. And this is SMSF because big funds will be different, which, I'm not sure how you can have sector neutrality when the big funds and the little funds gets treated differently and the defined benefits. Anyway, I'll get off my high horse there for one moment. So values of assets at 30 June 2026. If you elect that, you can elect that value of all assets. You can't just pick them, unlike when we did do a cost base reset back in 2017. You can't pick particular assets. It's either all of them or none of them. And you basically are saying all of my assets at 30 June 2026 will be the cost base for Division 296 purposes. So you'll end up with the situation where if you sell an asset, you'll have a CGT cost base and you'll have a Division 296 cost base. Now I'm doing, like those watching this on YouTube, I'm doing this with my hands going, well, you bought it back there, the time frame, and therefore you probably have a bigger gain for tax than you will for Division 296. But it could be the other way around, because when you bought it, it's gone down in value. And then if you run a Div 296 cost base of everything, because you elect on everything, and then when you sell it, I'm going the wrong way. When you sell it, it goes up there, but still down from a tax perspective. Then, you might have a taxable loss, but a Division 296 gain, and you can't pick. So that's going to be interesting. Also, one of the feedback from the announcement in October was that, again, that's all well and good if you bought your shares or your units in your unit trust or your property, the direct asset is all fine. But what about if you've got that, I'll call it the direct asset. So that could be shares in a company, units in a unit trust, but that entity has its own underlying assets. So if those assets, so you could have your Div 296 cost base at 30 June 26, great, but then you'll receive a distribution or a dividend from that underlying entity that flows up. You don't get, and that has a capital gain element to it. You haven't been able to run a separate cost base of the underlying assets in that entity, and that can give rise to some substantial timing issues. So if I talk about a property asset, you bought it in an unlisted unit trust, call it 5 years ago. You put some money in. It was a $10 million cost base of that property. At 30 June, you put in 200 grand. At 30 June 2026, that's now worth 600 grand. So say the property's gone up to 30 million. I'm trying to do the numbers in my head. It's a hard one, that. So it's gone up to 30 million. Now you can have your Div 296 cost base of the units at 600,000, but you don't get to run a separate cost base of the underlying asset. So if that unit trust sells that property for 30 million, or say the next year at 40 million, so your units have gone up to 800,000, and there's use my brain, $30 million capital, CGT event in the trust. $30 million gets distributed out to everybody. And so the super fund will then have a distribution of a capital gain from the underlying entity, but that'll be based on their $200,000 investment originally, and not that running a separate cost base. Now, what would happen then if that was the only asset of the entity? That would likely be wound up. So then, that may well come through as a Division 296, like a loss there, but you can't carry forward a Division 296 loss. So you can only use it in that year. So maybe that can offset a gain, a Division 296 gain in that year. So it's unclear. So that, again, super simples. But,
Yeah.
is it really fair from that perspective?
Well, again, I think all that you're highlighting is that the different scenarios haven't really been properly thought through here. As in,
No.
and I'm not saying it's easy, but this is what these people are paid to do, is to work through the intricacy of, okay, and if you're going to whack SMSFs like the original policy was supposed to whack SMSFs, how about putting some work into, okay, well, this is how their investment structures work. How's it going to apply to this scenario? And
Yep.
we're not plucking stuff, or you're not plucking stuff out of the air where it's like, oh, Jemma, I've never heard of trustees doing that before.
Yeah.
You're taking an extreme outlier on the bell curve and trying to make an example of why this tax. No, 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 no. The scenario that you
Very
just
common.
described is extremely
Extremely
common.
common. Yep.
So,
And
how
even when you think of like ETFs, or sorry, ETFs probably it's still not a bad, because you can have your Div 296 cost base of that because they're listed. But if you think about, but in the underlying asset, but managed funds are a big one. But then what do you do to try and have a Division 296 cost base of all the assets that might be in that managed fund at 30
and
June? I'm sure that like someone could just run some boffin can write a program that deals with it. Or the like a self-managed fund could, the software people could look at it. The other thing is that every year the assets have to be valued. So you're going to, like, all of those underlying assets within that entity will be valued to give you the value of the unit trust at that time. So there's going to be some sort of schedule, for want of a better phrase, that will tell you what those assets are. But then it comes back to how are we practically implementing this. So we don't know what this election will look like. Back when the CGT relief occurred in 2017, it was actually not that, it was a disclosure in the tax return or the annual return of the fund with, are you using CGT relief? Are you deferring anything? And you would tick yes if you were, and you'd put in what the deferral amount was. It wasn't a schedule that listed all the assets and what you were resetting the cost base for, what you were deferring of that, all of that sort of stuff. It was what's in the ECPI based on that cost base reset went into that little box. And if you were deferring again, that was a different, like, couple of check boxes, and that was pretty much it. And then everything else was held for the records of the fund. So it's going to be, I expect, a similar thing. You tick the election in the return, and then you're keeping the work papers separately. So it's going to be really interesting to see how
well,
that all works.
from what you're describing, Gemma, from an administration point of view, it's almost like you're going to have to run two parallel sets of accounts for
Yeah.
your fund. I mean, it's
Oh, I
almost
don't know
like a
about that. I'm not sure on that front because, again, if you've ticked the box to elect, then again, 30 June 2026 value. But the challenge that I think from an implementation perspective will be, so you tick that box in the annual return for 2026 and say, yep, we're running that cost base. Then in the 2027 year, when you sell an asset, and you're going to have a taxable gain, which you'll include in the tax return of the fund and say, there's losses there or whatever, you include all of that. But then how are you telling the tax office that, notwithstanding that taxable gain, you've got a different Division 296 gain? So is that like, how's that going to look in the disclosures? So then, because they're the ones who are going to have to do the data matching and say, okay, well, yep, that your taxable income is this. We've added back ECPI. We've added back. We've taken off contributions if there are any. So this is the line. But hang on, now we've got to take off the realised taxable gain and add back the Division 296 gain. Whew, where are they getting that info? Like, how's that? So I really feel for the tax office as the implementers and the administrators and the regulator for this, because they're the ones who are going to have to figure out what information they need to capture on this front. And then the other thing, get started. Always get on my high horse. So if you're someone who has so you've got an SMSF and it's worth $5 million, your account. So you're like, yep, I'm in scope, as they call it. I'm in scope, da 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 da. But let's say you also have an APRA fund like member account. It might be a couple of $100,000. It could be 10 grand. Could be, hardly anything or quite a bit. So then that fund, they're looking at, all right, Gemma's account is worth, $10,000 in this fund. So she's not going to be in scope because they're not going to know that I've got an SMSF over here worth $5 million. So every member, like they're going to have to be doing. So this is where the big funds are impacted far more substantially, almost by these changed measures than SMSF, because they're going to have to change their systems and reporting. And on the big fund side, because the running a separate cost base for Division 296 purposes is just probably going to be a bit of a disaster. Although, in discussing it with a few people that work in the teams there, they've said, oh, no, software could probably do that. So, anyway, depending on the platform that the member is on and da 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 da. But they have they're looking at a different way that it is run, and it's based on a 4 year, like a factor of the realized gains over a 4 year period. So that's yet to be ironed out, and that's regulations. But that's on the basis that a lot of the assets that a big fund might have would basically be recycled or like over that 4 year period would effectively have been refreshed. So so anyway, again, the feedback I've had from some big funds is that no, big funds have got assets that are in there for many years. Now some of them own whole buildings worth $500 million and things like that.
I'm sure
So
CMUS does.
yeah. I know Gesby in WA, owns a building that I can see right next to my office. And, that's nothing. And they've owned it for 15 years or something ridiculous. So it's not just, oh, yeah, that gets recycled over a 4 year period. So that was another part of the submission for the Tax Institute anyway, because they've got both SMSF and big fund members. So that whole CGT cost base, sorry, Division 296 cost base consideration, it still needs quite a bit of work. And the other element of that is obviously we've spoken about little funds, the SMSF, we've spoken about the big funds. What about the defined benefit funds? So the defined benefit funds are almost going back to the old proposal, which is opening, closing adjustments. So you've got three different, so that's the calculation of what that looks like for a defined benefit scheme. So there's three different provisions for each class of fund. So one of the
Yeah,
big things was fair and reasonable, easy to implement with existing measures. Sector neutrality. I couldn't find where that had been actually said by the minister or Treasury, but that was bandied around because then people. I mean, if you're in a defined benefit, you can't really do much about that generally. But will people like move towards a particular fund because of the treatment of this? And that's what they were trying to like make sure didn't happen.
yeah, no, I must admit, I haven't actually seen any submissions from the larger superannuation funds. I'm sure they exist, but they don't come across my desk.
No,
But
no.
I have absolutely no doubt they will be lobbying the government pretty bloody hard against anything that they recognise that no, that's just not going to work for us.
Mm,
So you're going to have to change this. So, as we said at the start, there is still a lot of water to run under this bridge.
yep,
And we haven't, what we've analysed really is the immediate effect on SMSF members
yep.
and how they're going to have to approach this. But we haven't even looked at, not that we would look at it, but we haven't even really discussed, well, how the APRA regulated funds seeing this. I haven't heard a lot of shouting from the rooftops that they're not happy about it. So I don't know what's going on in the background, but I think it would be naive for any of us to think that they're not lobbying
Out there.
as
Yeah,
hard
exactly.
as
Yeah.
they possibly can to try and, I mean, they don't care about anything else, just whatever's egregious for
Mm,
their operation, they will be lobbying Canberra as hard as possible to change it. And whether or not that prompts a change again in the legislation, you know, who knows? But that's definitely going on in the background.
oh, absolutely. And this change, the backflip to this current, realised. Well, I feel like the SMSF Association was lobbying substantially, saying, well, why should it be open and closing, and with a what's the difference? We can do actual taxable gains, and we can show that at a member level. So, I mean, I've got to say that is a fantastic outcome for the SMSF industry. Not so much having an extra threshold and all that other sort of stuff. I guess I haven't looked at the actual numbers, but the statistics, the people that are over 10 million is not that many out there. I mean, more and more people, because just with the increase in wealth and the way the share market's going and blah, 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 those usual things, people are going to get up to that level. The other thing that, with all these like new taxes that come through like this is this generation of people that are got more than $3 million in super or more than 10. That's going to be really difficult to accomplish for the next generation down. So I feel like the actual longevity of this tax itself isn't that long, because you're going to have the situation, especially as this is indexed, you're going to have the situation that sort of layer of members who are over 3 million now, they're older. So between in the next 10, 15, 20 years, they're going to die, and all this money will come out of super and then be invested elsewhere, and in individual names, trusts, blah blah blah. So then the application of these provisions to the remaining members, or the remaining people in super, it's just not going to be that many.
Yeah.
It'll be anomalies, because it's just you can't build up that level of wealth anymore in super.
Well, that was actually a point that was raised right at the outset.
Yeah.
With the government's aim is trying to reduce these mega superannuation balances that they perceive to be. A lot of the argument was, but there's already
Mechanisms in
mechanisms in
place.
place to stop that from happening in the future. So again, it probably goes back to your point about short-termism, about
Mm.
how can we make a bit of a cash grab to fix our fiscal holes in the short term, because you're right, the longevity of this tax and the effectiveness of it is not likely to be for an extremely long time period. So again,
And I don't know how much of a cash grab it is going to be. It's not like, you remember the temporary budget repair levy, where everyone
yes,
got whacked with an extra 1% tax,
yes,
in addition to the Medicare levy. That applied to, I think it applied, I'm trying to remember now, applied to everyone. It was rubbish, but
I think it
it,
did apply to everybody. Yep.
yeah. And so it was like, right, that's here you go, extra 1% of everyone's taxable income into the coffers. And whereas this is going to be the first assessments will not occur until after 30 June 2027. So a lot of SMSFs, their due date is May. So 2028, May 2028, will a lot of people will have their super funds lodged, and that it's taking longer and longer for us to get some of the information through from people's investments and things. So that date is often what happens. So they might not be getting any assessments or a lot of the money for this for nearly 2 years after it's introduced
Yeah.
or it starts. The other thing will be if you're a super fund that's got lots of exempt current pension income, and you're expecting a nice big fat franking credit refund, are you going to be like, right, well, if I lodge my return in September 2027 and I get my $300,000 refund, but then I'm going to be hit with Division 296 tax a couple of months later, then do you put off like lodging because you don't want to have to pay the tax? So people will make those sorts of decisions
Yeah,
as well.
100%.
So anyway, I just think that that sort of thing is going to happen. And then of course you've always got the, well, are we gonna end up with a situation of, before someone invests in something in their fund. And when I say something, that's really clear, isn't it, Jemma? A big chunky asset like a property, like commercial property or farming land or vacant land that might have development potential. Like they might be, like, take a step back and think, okay, well, super is the place for it, because if I sell it in 10 years' time, then I'm going to have a really good tax rate on that, even if it's at 10%. But if that is going to, I'm going to have to get it valued every year because it's in super and, that needs to happen. So it's going to impact that total super balance ending or and closing. So, how's that going to flow? Like that impact on other things. If it's vacant land and you're just land banking it, well, it's not generating any income. Do I just plonk it in another entity outside super? So people are, which I think we've been saying since February 23, people might change their investment decision making. But yeah, I can see again that being that happening for a lot of people as well. Just being a bit more strategic about the profile of assets they might have in super because of how these rules are going to work.
You mentioned franking credits a minute ago. Has anything been decided about that? Because I think that's probably still up in the air. CPA Australia actually included in its submission
Mm.
about what's the treatment of franking credits going to be. They
Well,
didn't
because
know about
from a
it.
taxable perspective, you've got it's included in taxable income, and then you get a refund of the whatever the amount
Yeah,
is in
of
the
the
tax
imputation credit. Yeah.
return, and it's part of your taxable income, so it would be included, and there wouldn't be an adjustment for Division 296, and I think that's correct. When you think if you didn't have so instead of so if you look at the alternative, so you've got shares, a portfolio of shares in listed Australian companies, you get your franking credits. Or you've got that, so you get 100,000. Oh, let's jump that up a bit. You get $1 million worth of dividends from those shares, but then that is only the equivalent of 70% of the actual profit within those relevant shares and businesses because that 30% has been paid on your behalf.
Yeah.
So really, if you're getting a refund of all of those franking credits, let's call it, then you should have included that whole amount in your taxable income. So if you didn't have shares and it was a property that generated rent of $1 million, then you would, well, it wouldn't be a million. Oh, I've done my wrong numbers here. So I'm going to go back and say it's $700,000 worth of dividends you receive, but really 30% of like it was a million, but 30% was paid on your behalf by the businesses that paid it out to you. I'll get there eventually, Darin, just bear with me. And then, but if you were an individual and it was $1 million worth of rent, then you actually get your $1 million, and then but you then pay tax on it later. So it's sort of it levels the playing field with the way that that all works. So I don't think that franking credits should come off the Division 296
But,
tax because they're different
but
considerations.
but isn't that kind of counterproductive to the whole franking credit thing?
But you've got the franking credits back if you've got them in from a taxable, so at the fund level. So, this is back to again, we've got these two buckets where the fund is one bucket and it's got its own tax position, but then the individual bucket is how the Division 29. So really the cost base, separate cost base for Division 296 purposes, that's really at an individual's sort of level, not at the fund level. So we're cross-populating these two entities by having to run a separate cost base that the fund will probably run and disclose the Division 296 realised return to the tax office, even though it's an individual tax in this bucket. So, yeah, they're just two different buckets because the franking credits get refunded to the fund bucket, not to the individual bucket. And that
Yeah.
has, I'm just so confused already.
Well, we've
Confused
only
myself
sort of just,
substantially, Darin. Not that
but,
that was that
but
surprising.
but we've just really only scratched the surface. I
Yeah,
mean, a lot of this analysis that you've done and other people have done has only occurred since the 19th of December, which is
yeah.
not a very long period of time. It's only just
Which means it was
over a month
probably
ago.
in the last fortnight because everyone has been on holidays.
Yeah, so
Mm.
I'm expecting a whole lot of other issues to
Stuff
be
to come through.
raised.
Yeah,
And look, how that's going to affect this whole process, I don't know. But just the saga continues, doesn't it?
yeah. Well, the other, I mean, we haven't even touched on some. Oh, I've run some numbers. Get the spreadsheets out. Excellent. And death is one that doesn't have great outcomes in terms of, the fact that a dead person gets hit with the tax. The other one is divorce. So from a divorce perspective, if you're splitting your account to the other person, then closing total super balance is likely to be less than your opening, but you still get hit with the tax based on the opening. And then the other person, it's based on the closing if they're getting it. So it's not particularly, it's going to be extra tax probably for both parties. So that's a bit rubbish. Now, again, we're talking people that have got big, large amounts in super from that perspective, or actually maybe even not. Someone they've both got two and a half, and Homer splits $1 million over to Marge. So maybe it just impacts her. But if he had five and she had, anyway, all of those little bits and pieces need to be factored in. And the reason why I bring up divorce is because a lot of uh, the things there is about the negotiation of who's getting what. So if you're then having to factor in not a phantom, but an estimated maybe tax based on what the value of the assets might be at a point in the future, like that's just anyway.
I'm interested that you
Anyway.
always use Homer and Marge as the example. You never work in, say, maybe Padme and Anakin.
Oh, they're boring. They're boring.
Oh,
I didn't like that. I didn't like that storyline, I have to say. But maybe
you
it's
know,
because the movies were just not good. Like that episode 3 was like the
no,
acting was
I hate
awful.
one to
That was
three.
an awful movie.
I
An
hate
awful
one to
movie.
three.
And Hayden Richard Christensen, bless him. Um, I love Natalie Portman, don't get me wrong. She is amazing, but it was so wooden and just that like the anyway. Sorry, we've digressed substantially. This is not a
All right,
podcast
well, I'll
about
give you
Star
an
Wars.
alternative. Han
Ha-
Solo and
Hans
Leia.
and Leia. Yeah,
Yeah.
I've have used them. I don't know. Homer and Marge are always my go-to.
Okay, fair enough. Fair
So I
enough.
love them. Yeah.
I think we've run out of time,
We
Gemma.
have run out of time
We've
and we
only
could
just
talk about
scratched
this.
I know,
Yeah.
we've only just scratched the surface. Now, the SMSF Association National Conference is coming up, and
Yeah.
I'm sure we will find out a lot more about this. Now, we
Yes,
don't
we
want to
will.
go on ad infinitum about this, but we still do want to give you the complete picture of what the latest developments are, which is why we keep revisiting this
Yeah.
subject. Because look, it is obviously a significant change, but
Yeah.
yes, we get it that we keep banging on about this, but hey, look, it's Jim Chalmers that keeps making us
Keeps
bang.
changing his mind. Yeah.
Blame Jim.
Blame the politicians.
Absolutely. I
Always,
don't think anybody will have
always.
any
We could
clue.
do a better job, but
Absolutely.
I would
Absolutely.
absolutely not want that job. That's for sure.
Oh, I'd be happy to take it on, but I don't think I'd be that popular in Canberra anyway. Anyway,
Hilarious.
as I
Hilarious.
said, we've had so much fun that we've run
We
out of
have always.
As usual, I would like to thank you, Gemma, for providing all of that insight and nerding it up so much about the Division 296 tax again.
Yeah. You know me. I love a good nerd up. So, yeah, perfect.
Very good. Thank you very much to SMSF Property Valuations for their continued support of these podcasts. Thank you to my production team, obviously, for putting all of these things together and making sure that they get published and distributed on all of our media platforms. Don't forget, if you're enjoying our content on YouTube, please smash that like button and hit subscribe because it really helps us out. But most importantly, thank you to all of you for listening and joining us on these podcasts. We have a lot of fun. We hope you have a
We
lot of
do.
fun listening to them. That probably says something about Gemma and myself, but we hope you have a lot of fun listening to them anyway. And look, until next time, travel safely, and we hope you'll join us for the next episode of the Cross Country Super Podcast. See you later.
See you.